I'm here today with Austock Life's Head of Investment Operations, John Laver. Thanks for coming in, John.
It's great to talk to you, Maree.
So, John, how are the tax rates calculated and provisioned within each benefit fund option?
Interesting question, Maree. Tax within the insurance bond is provisioned on a daily basis. Whilst having a headline tax rate of 30%, each benefit fund option has a unique effective tax rate depending on the characteristics of the underlying investment.
So what are some of these characteristics that can lower the headline rate?
Factors such as franking levels, foreign tax credits, and the level of unrealised capital growth of an asset class all lower the effective tax provision below this headline rate. The lowest effective rate we currently have on the menu is the Geared Australian Shares Fund, which provisions tax at 24% per annum.
Is all tax provision within a benefit fund immediately payable to the ATO by Austock Life?
The types of tax provisioned by a benefit fund can be split into two categories. The first is realised tax. This is made up of income distributed and the realised capital gains or losses distributed out by the underlying investment. It is the component an ordinary investor outside the insurance bond structure would include on their yearly tax return. It is paid by Austock Life quarterly to the ATO. The second type of tax that is provisioned is unrealised capital gains. This is the paper reserve that is generated from capital gains or losses on an underlying investment. An interesting note on this is that even though unrealised capital gains are provisioned for, it is physically still invested and generates income and growth until realised. This unrealised capital portion is not immediately payable by Austock Life and is still fully invested on behalf of unit holders until crystallised by the benefit fund.
What happens to tax payable in a year of abnormal growth in investment markets?
Yeah, look, that's an interesting question, Maree, especially considering the volatile markets we sort of find ourselves in at the moment. Actual tax provision on a yearly basis can deviate significantly from the effective rate. In years of poor or negative capital growth, actual tax provision by the benefit fund is significantly below the effective rate provision. This is because every dollar of negative capital growth, a tax asset is generated on unrealised capital losses at the effective tax rate of the benefit fund.
So, John, is my client's money locked up in an insurance bond for at least 10 years?
An important distinction needs to be made here. Whilst there is a 10-year term on receiving personal tax-free distributions, money is accessible to a client at any time. If withdrawal happens within the first 10 years, clients receive a 30% tax offset on any tax-assessable amount. This effectively credits back the tax paid by Austock Life within the structure. Even if the effective tax rate of a benefit fund is considerably below 30%, clients are still entitled to this 30% offset.
So are there any additional benefits to placing my client's money in an alternate tax structure?
Warehousing your money in the insurance bond tax structure gives you control over when and in what form you access your investment proceeds from a personal tax point of view. You are no longer at the mercy of an investment paying out unwanted realised capital gains or paying distributions at a time when the tax situation makes it inequitable.
So, John, any further comments?
Well, the last thing I can say is it's a great product, Maree. It's time to start thinking about how an insurance bond can fit into your client's life event and tax planning strategies.
And where can we go to find some more information?
You can go to our website, which is www.austocklife.com. You can call one of our distribution team, which is located all around Australia, or you can give me a call.
Thanks for your time today, John. Appreciate it.
Thanks, Maree.